there is a numbness in the market. I'm not using the word scare here, but numbness in the market means that nobody wants to commit more capital. The active demat accounts have come down. Everybody is now talking about what Fed would do without realizing that where the interest rates in India are moving. The peak of inflation is behind us. That is what RBI is. That is the last official statement from RBI. But the narrative clearly is centered around what Fed should do. Nobody is talking about the decline in commodity prices. Everybody is now suddenly focusing on what will happen to IT and the collateral damage, the layoffs will happen. So the narrative of the market has changed because the price performance is not there. And that is what is important for us to understand. That is the nature of the equity market. When the going is good, everything looks good. When the going gets difficult, then we tend to over amplify bad news. But when the going gets tough, they get going. That's the spirit I'm sure Saurabh Mukerjea is going to be adopting when it comes to managing money and dissecting the market. So it's been a tough market. It's been a tough market for investors, for traders, and even for television commentators like us, because there's hardly anything to comment on.
No, I think it's been a tough year for everybody. I think I've never seen both investors in India and investors in the Western world feel so subdued by the turn of events. So after COVID, there was widespread expectation that we would see a recovery, but I guess the war that started a year ago put paid to some of that, and the inflation that it engendered has led to these rate hikes. My reckoning, though, is that if we do get a US recession in the coming few months, which is what the expectation is now, given the credit tightening in America that we are seeing on the back of these bank collapses and the credit tightening, I think we'll also see in Europe. If we do get a recession in America in the coming few months, that generally will be the bottom of the top of the rate hike cycle. Difficult for the Fed to expedite rate hikes if America is going into recession and banks are blowing up every week. And back home in India, we're fortunate that our economy is in good shape. I think we'll carry on having healthy corporate earnings. Across our portfolios, I'm seeing around 25% EPS growth in the year that's going to end next week. 25% EPS growth, and yet our portfolios are down typically around 15%. So if you have that sort of disconnect, Nikunj, where earnings are up 25 and share prices are down 15, as an investor, you really have to.
Okay, we lost him there. That's volatility in the network connection, nothing to do with markets. That's the volatile network connection. When markets have turned volatile, network connection sometimes can turn volatile. What's come down, I think, is HDFC EMC. What's gone up is Quest Corp. I think there's a reverse book building there, Anisha?
Correct. A reverse book building to the tune of 4.5%, and the buyer is looking to pick up the stake at a premium of 12 to 15% as well. So clearly that's having an impact, 6% higher. But Saurabh, since you're back with us, please complete your point where you were saying that there's a disconnect between where EPS is expected to grow by 25-30%, but the portfolio is down 15%. What does one do?
I think you buy more, right? When companies that are consistently compounding earnings year after year, their share prices are not moving, or indeed they're going down, you buy more. So just to take a giant example of that, HDFC Bank in scale and size, both in terms of balance sheet and in terms of profits, has more than doubled in the last 3 years or so. It's compounded at 22-23%. So the bank has more than doubled in the last 3 years. So in terms of size, and yet the share price action is, I think, easily 3-4% per annum. So it behooves us, we exist as equity investors to capitalize on situations like this. Sometimes these sorts of situations happen in a flash. So 3 years ago, COVID happened in a flash. In a 90-day period, it opened up a window of opportunity for us to buy great franchises at attractive prices. The last 12 months have been a slow grind, but the opportunity is similar. We've got great franchises available at very attractive valuations, and we've come in, therefore we are trying our best to load up on that, rather than waiting for the Fed to say that tomorrow morning we will start cutting rates. As and when that happens, that'll be great news, but long before that, we need to load up on great franchises.
Saurabh, I distinctly remember we had a conversation in 2020, and you made a similar case that a US recession is great news for India. Mm-hmm. Crude will come down, interest rates will come down. But while the recession is at play, it tends to impact global growth. it tends to impact exports, it tends to impact flows. So on the long term basis, yes, commodity prices come down, interest rates they come down, on the margin it will benefit India. But by the time you reach the recession, there will be a collateral damage to IT, collateral damage to exports, collateral damage to flows. How does one deal with that?
So, because I think where we stand in a very good place as a nation is because of the damage that's taking place every week between the US and China in their relationship. Because of that damage, we are seeing very heavy reallocation of business. So I spent the last couple of days traveling across Tamil Nadu, seeing the birth of the electronic manufacturing services industry. My reckoning is 10 years hence, the electronic manufacturing services is making phones, medical equipment, electronic devices. I reckon a decade hence this will be bigger than the IT services industry is today. Much of this industry is in China. Our electronic manufacturing services industry is tiny, perhaps 5-6 billion. I reckon this will become hundreds of billions of dollars in size. So every week, as the China-US relationship deteriorates, pharma manufacturing, API manufacturing, and now electronic manufacturing moves to India. I think this piece, the reallocation of global trade away from China towards countries like Vietnam, like India, will give us a real buffer. So a US recession should spell the top of the rate cycle in America. I think anyway with the bank blow-ups in America, the top of the rate cycle is all but assured. And the combination of a US recession with rate hikes peaking should also mean oil prices coming off. As you said rightly, I pointed out in 2020, every single economic move in India starts with the US recession because that brings down rates, brings down oil prices, and in a high energy entrepreneurial country like India, that's all you need to get moving with a solid economic boom.
Or let's say consistent compounded portfolio benefit if there is a US recession and if rates are down, because TCS, Asian Paints, Bajaj Finance, DVs, some of these businesses are not directly related with what will happen to the US recession.
So there will be probably some impact on TCS's earnings, but as you rightly said, TCS's main modes are on the supply side. The TCS's modes are not on the demand side. As long as TCS is strong on the recruitment side, 1 lakh or 1.5 lakh, 150,000 odd new quality recruits at affordable wages, TCS should be all right. And firms like Asian Paints, as you rightly alluding to, Nikunj, very little dependence on America. What typically tends to happen is when US goes into recession and the rate cycle peaks, the FII flows, which have dwindled to almost nothing in the last 12 months, they pick up, and the sorts of stocks you're flashing up on the screen, these stocks are loved by the FIIs. So typically in our country, this capital market cycle revs into high gear with US recession because money starts flowing from the Western world to India. Historically, we had to compete with China for those dollars. I don't think this time we'll be competing with China for those dollars, and therefore I reckon in the next couple of years, foreign investor participation in the Indian market could double or triple. It's currently around 0.6 billion FII participation. I reckon that number could double or triple in the next couple of years, given that foreign investors have 3.5 trillion deployed in China, and it's not made any money for them in the last 10 years or so.
Fingers crossed on those FII flows when they come back to India, because they seem to be on a bit of a hiatus as of now. But, I want to get stock specific and discuss a couple of your holdings which you have in consistent compounders, the likes of Divi's Lab and Dr. Lal Path Labs. Divi's specifically because it hasn't done much in a while now. It's been sideways. What makes you confident about that, and rationale for Dr. Lal as well?
So in Divi's case, if you look at the business today compared to where they were pre-COVID, the business is around 30% larger. Revenues are 30% larger. So strip out Molnupiravir, and even then Divi's is 30% larger. The firms don't buy a third through COVID. They had a gross margin hit in the quarter to December. Our reckoning is much of that will unwind. The raw material cost issues that were taking place in the quarter to December, I think, unwind. There is inventory destocking happening across the pharma industry, across the world. Some of that, I think, will still carry on in the March quarter. I doubt that the March quarter will be a booming quarter. But given that the company's top line has grown steadily over 20 years, has grown steadily even through COVID, stripping out Molnupiravir, as gross margins recover, this business is in good shape. We speak to several of their customers around. Their key customers are the world's 6 largest pharma companies. We speak to them quite regularly. And the view is this company has come out of COVID with their credentials burnished. Their credibility is an all-time high, and with Western pharma companies looking to reduce their dependence on China, we see these incredibly well positioned. So through November, December, we doubled our position in these. Coming to Dr. Lal PathLabs, somewhat similar, right? If you look at operating margins, they're higher today than they were before COVID. And this talk about competitive pressure, I think, is a lot of nonsense. If a company is under competitive pressure, you should see that pressure on operating margins. You don't see that here. This company's free cash flows are more than the rest of the path lab industry put together. Excluding COVID, business growth is around 12-13%, couple of percentage lower than what it was before COVID. But I think as we come out of COVID and we get back to our old routine of perhaps not being as hygienic as we were through COVID, as we sort of lose the habit of using sanitizers and washing our hands, I think we'll go back to 13-14% top line growth that Dr. Lal was accustomed to seeing before COVID. So competitive intensity is reducing in the sector as private equity and venture capital funding dries up. And we see Dr. Lal nicely positioned. So July, August, we doubled our stake in Dr. Lal.
Saurabh, where are you putting your incremental money to work apart from the fact that you've doubled positions in a couple of these pharma companies? Which are the spaces or the recent additions that you have made to your portfolio?
So I think we haven't added Tata Elxsi in our mid-cap portfolio. That was our last big addition. I think you flashed on your screen. We got out of Relaxo and added Tata Elxsi around 3 months ago. The other addition we've made in our financial services portfolio is in the midst of this mayhem around capital gains tax on debt or income tax on debt mutual funds. We've added Prudent Corporate. Prudent is a wealth manager. It's a wealth management platform for the IFA community. We've added that to our Kings of Capital portfolio. We see this space as being very attractive. We think the mutual fund story in India will play out amongst the mass affluents. What Prudent has done is built a platform which has 25,000 IFAs. The IFAs bring in mutual fund business, they bring in insurance business, and Prudent gets a slice of that action. So we've added Prudent in our Kings of Capital portfolio, and we'll monitor Prudent over the coming months to see whether it merits additions in any other part of Marcellus's investment universe.
Good idea to buy the stress in AMCs. A year ago, 4,000 rupees for HDFC AMC. Now the same business, even 20% higher in terms of the AUM size, is available at 1,600.
So I think the debt industry and more generally the mutual fund industry has a good runway ahead of it. Yes, SEBI will tighten regulatory loopholes, or the Finance Ministry Delhi will tighten tax loopholes. But given the sheer quantum of financialization that lies ahead of us, right? I reckon something like $1 trillion will come into financial services products over the coming 10 years, life insurance, mutual funds, AIFs, PMSs. We need to have investments in this industry. Rather than playing the mutual funds per se, Nikunj, we prefer to do it through an intermediary like Prudent Advisory. And our view is that competitive advantages that if, say, an unlisted company like NJ and a listed company like Prudent have, these competitive advantages are formidable. In effect, they're the gatekeepers who stand between the mutual funds and the broader investing public, right? So wealthier people go through the Kotak Wealth and IIFL and so on. But for the mass affluent, for the less wealthy people, firms like NJ and Prudent have built very effective low-cost platforms for the masses to access mutual funds. And I think this is our straightforward way to play the epic financialization that lies ahead for India in the coming decade. Just one disclaimer, I am an investor in all of these stocks through our PMS products, so are my parents, and so are our 10,000 clients.
Thank you for the disclosure. I come back to some of the internet stocks. Today they look expensive. They don't make profits. But if you have to extend the timeline, 3 years, 5 years, the businesses could be different. The demographics would be different. So somebody who says, look, I am in the long haul, do you think there is merit in buying some of these stocks? Today they may look bloated up, obese. In your framework, they will not even pass through the first filter. But is it time to stretch it for next 5 years and then look through them?
I think there is merit in doing that. But the only thing is we need to look out for companies with distinctive capabilities, right? Because there are lots of clever coders in our country. There are lots of clever entrepreneurs. If tomorrow morning Saurabh Mukerjea starts a pizza delivery business, it's difficult for me to tell you, Nikunj, that I have built a moated pizza delivery business or I have built a motor business for delivering cabbage to Nikunja's house, right? And therefore, the search should be for companies which have distinctive capabilities, so companies that can do something that their rivals cannot. And as I've said in the past, we keep looking at Nykaa and saying, are they in that space? Has Nykaa built a platform? Has Falguni Nair and team, have they built a platform which is distinctive, which is unique? There are elements to what Nykaa does which we think are very clever, very unique, but I think they could do more on the tech platform. And we're keeping an eye on that. Our focus has typically been to understand the business fundamentally. What does the business bring to the table that nobody else can? And if we find such businesses, given that valuations have come off, we would look to invest. But as yet, that search continues. Yet to find too many digital businesses in India which have distinctive capabilities. InfoEdge remains in our mid-cap portfolios as one such business. I think the Naukri platform is utterly unique, and the PC business that Sanjeev Chandani and team have built using the cash flows from the Naukri platform is a very clever way to monetize the free cash flows coming out of Naukri. So if somebody else out there builds a Naukri, builds something akin to a Naukri, a distinctive, unique business, we would love to invest.
You are investing, Saurabh, you will never look at companies which don't generate free cash flow. You would say, look, that's a no-no for me.
So, you can turn around my Divi's bull case around and tell me rightfully that 20 years ago, Divi's did not generate much free cash flow. Around the time it went public 20 years ago, Divi's ROC wasn't particularly higher than cost of capital, which means it didn't generate free cash flow. And if I had any brains 20 years ago, I was still just out of university. If I had brains 20 years ago, I would have turned around and said, Murli Divi, uniquely talented chemist, he's building a high quality franchise. Mr. Divi has unique capabilities, distinctive capabilities. Let's build a position in Divi's lab. So as we get older and we become more capable of identifying businesses where ROCE apart, free cash flows apart, a promoter brings to the table distinctive capabilities, it becomes easier for us to build positions in such companies. In a way, ROC and free cash flow is a proxy. We're saying that because ROC went dry, this promoter has distinctive capabilities, but fundamentally, what you're looking for is unique businesses, unique skill sets that nobody else possesses. And if you can identify them, you should go and build positions in that. Just make sure the promoter is an honest person, because if he's not honest, then the unique capabilities, the upside from that, he will skim away for his personal wealth rather than sharing it with you.
Sort of one take on consumption, because I see that doesn't have a very big allocation. Of course, you have it through paints and Page Industries, etc., but no hospitality company, no big auto name, etc., and not even FMCG for that matter. Is there a reason you are sticking away from consumption, even durables for that matter?
So again, I think it's the distinctiveness point. So if you see FMCG in our country, I think increasingly the moat of the FMCG franchises, by and large, most of the FMCG franchises, I think their moats, their distinctiveness is being eroded by direct to consumer. So direct to consumer itself doesn't make a lot of money, but hey, if I can get say hair oil, cooking oil, a whole range of FMCG products D2C on my app, even though the DTC provider might not make money, it erodes the competitiveness of the standard FMCG player, and that's something we've been very wary of over the last couple of years. Our only conventional FMCG play is Nestle, because it's not possible to sell baby milk powder D2C. It's a very difficult industry to enter. There's licensing, there's restricted selling, and therefore Nestle remains our core FMCG play. The rest of the FMCG plays, I think the moats are eroding as D2C comes of age in India.
Saurabh Mukerjea, really appreciate your time. Solo guy, you could join us and look to see more of you going forward.